Hello everyone, let us continue with our discussion. The previous lecture ended because of some technical error. Okay, so let us continue with our discussion. So in the previous lecture, I have discussed the fourth point, that is your ex post and ex ante. Okay, now starting with the fifth point, give the heading data mining and fake patterns. Data mining and fake patterns. Now, what is the meaning of data mining? Data mining means searching for the pattern until you find something, means you're trying your best to get some pattern without logic. Like Nifty will rise when India will win a cricket match. So there is no economic logic. But by chance, data will show that yes, they both are correlated. There is a possibility by any chance. Okay. So it is data mining, and I'm trying to develop some fake pattern without any logic. Clear? Now there is one more point. Suppose I want to prove that small caps always outperform the large caps. Okay, so now what I've observed, that if I'm taking the period of 2000 to 2018, if I'm taking this period, okay, then it shows that large cap is outperforming. Clear? But if I'm taking the period of just 2000 to 2010, small cap is outperforming the large cap. So that is also dependent upon being an analyst, that which period I should choose, because I want to show what I believe, and whatever I feel that it's right, I should go with that. Are you clear? So I'm trying to modify the outcome of the data as per my own wish. Clear? So to overcome these things, you need to ask to yourself, does this relationship makes economic sense or not? If there is no economic sense, leave it. Clear? Also check out of the sample testing, means you have tested that in 2000 to 2010 small caps are outperforming. Now what you will do, you will recheck it from 2010 to 2018, then recheck it again from 2018 to 2025 to really check that whether the small cap have outperformed or not. Check out of the sample testing. This was your sample. Now you are testing the same result on the other data set. Clear? And if it satisfies, then yes, otherwise leave it. Clear? Now coming to the sixth point, failing to use conditioning information. Now what is the meaning of this point? See, what I'm trying to say, that sometimes the historical relationship changes in different conditions. Like I'm saying that Infosys, okay, generally during the economic expansion, the beta is lower. Clear? Or 0.9. But during the recession, okay, the same beta changes to say 1.4 or say 1.6. Now it is becoming risky. Earlier, it seems to be a safe haven, but now it is not. Clear? So forecasted beta must depend upon what you expect, whether you are expecting the growth or whether you are expecting the recession. Clear? Like students score, okay, they score well when they are relaxed. Clear? But they will score very poorly during the stress time. Clear? So exams are coming when he is stressed, then definitely his marks are going to be poor, and exams are coming when he is relaxed, result is going to be better. Same person, different conditions, different results. Are you clear with this? Point number 6. Now coming to the point number 7, which is from the side of the analyst. Okay, they misunderstood the correlation, like misinterpretation of correlation. So what over here I am trying to say, I am saying that correlation means two things are moving together, but it does not means that one is making the other to move. Like what I'm saying, that A and B, okay, if A will increase, B is decreasing. Clear? Two things are moving together, can be in the same direction, it can be in the opposite direction, but this does not means that if A is rising, it leads to the B to fall. It never happens. Clear? There is a correlation, but one is not driving the movement in the other stock. Clear? Like Infosys and TCS, there is a very high correlation between both of them. They both are from the same industry. Clear? So if one is moving, another is also moving. But suppose you get to know that there is a bad news in Infosys, hence it's coming down. Do you think it will make the TCS to also come down? Definitely not. Okay. If the event is from the industry perspective, if you get a news which is going to impact the IT industry, then yes, they both are going to come down. Are you clear what I'm trying to say? So it's a misinterpretation from the side of the analyst. So one thing is also I want to tell you, because see, in future you are also going to be an analyst. Okay, try to differentiate between the correlation which are accidental. Okay, some correlation will not make sense, they're useless, meaningless, but still you will find that yes sir, there is a correlation. Like Infosys and say Tata Motors, I don't see any sort of huge connection between both of them. Okay, but still you find out that there is a very huge high correlation. It's by luck, it's by chance. Clear? And second, correlation only captures the non linear movements. Non-linear movements are not captured by the correlation, so that is also a drawback between both of them. Clear? This is your point number 7. Coming to point number 8, psychological bias. See, there are many psychological bias. We will study in detail in the coming topics. Like right now, I'm just giving you a brief of that rather than going in detail. One is your anchoring bias. Means anchor means what? You put a hook to something. Okay. Similarly, whatever you hear some news very first, okay, you have given too much of weight to it. Like if the analyst will say recession is coming, now others will stick to that idea. You stick to that idea rather than using your own intelligence, your own brain, or listening to others. Anchor, you are anchored to one given information. Status quo bias. Clear? We assume that future will look like the present. Means inflation is 4% today, I'll forecast the same 4% tomorrow, but it's not true. It can increase, it can decrease based on the different market scenario. Confirmation bias, we search only for evidence that support what we believe. Like I believe that this question will come in the exam, so what I'll do, I'll try my level best to make you prove that see, this question came twice previously, so there is a high chances that this question will come again in the exam. But why I have done so much of research? Just to ensure you that what I am saying is good, is final, is up to date. Clear? So confirmation bias, I feel that I am correct. Confirmation bias. Overconfidence bias, we think that whatever forecast which I made is correct and I ignore all my past mistake. Overconfidence bias. Prudence bias means we give conservative forecast so that we can avoid the embarrassment. Like I say that there is a possibility of 4% return in the given stock where I believe that it can be 12, but I'm afraid what if 12 will not come? So I'll say the safer side 4%, where high probability that yes, we can achieve this much amount of return. Availability bias, see, we give too much weight to the event that are easy to remember. Like someone who show the 2008 crash may always think that market will crash. Okay, availability bias, whatever information I have, I try to remember that and I try to feel that the same thing can happen again. Clear? So there are 6 bias I have discussed: anchoring bias, hook; status quo bias, whatever happened in the past will happen in the future confirmation bias. I'm trying to searching the evidence. The question will come in the exam. Overconfidence, whatever I have given you is correct, ignoring my past mistakes. Prudence, conservative, safe forecasting. Availability, things which are easier to remember. 2008 crash. Clear? Now coming to the point number 9, that is the last one, is your model parameter and input uncertainty. See, when you are driving the forecast, okay, you are using the model and you are using the data and you are using your own judgment as well. Clear? So when I'm using the model, see, choosing the right model itself can create a issue. Suppose I'm using the DCF model where the company is having highly uncertain cash flow. I'm using the wrong model. So I should go with the better model. Clear? Now in the model, there are multiple parameters. Parameters like growth rate, GDP, beta, risk-free rate, volatility. What if these parameters will go wrong? My final outcome will also be wrong. Clear? So I need to ensure that my model is correct. I need to ensure that my parameter is also correct. And the third one is the input. Input means the data which I am giving. It can also be wrong. Clear? So when I am going to develop a model, I need to choose the right model. Then I need to choose the right parameters and the right value for the parameters. And finally, the right input for that particular model. Clear? So these are the 9 points where I've discussed each of them in minute detailing. Okay, so in this lecture, I am going to finish your LOS 2. Thank you.